Imagine waking up one morning and realizing that the world's biggest banks don't have money, that $1 million homes were built on lies, that people who thought they owned houses actually didn't, and that one bankruptcy could shake the entire planet. Right before we dive in, here's what we're going to cover in this video. We'll break down how low interest rates in the early 2000s fueled a massive housing bubble, the macroeconomic logic behind monetary policy decisions, how adjustable rate mortgages turned into financial landmines, while leverage made banks incredibly fragile, how the collapse of Lehman Brothers triggered global panic, and how the Federal Reserve used interest rates and quantitative easing to prevent total economic collapse. By the end of this video, you won't just understand what happened in 2008, you'll understand how interest rates shaped the entire global economy and why the next crisis could begin the exact same way. Let's get into it. After the 2001 dot-com crash and the 9/11 attacks, the US economy slowed sharply. To prevent a deep recession, the Federal Reserve slashed interest rates. By 2003, the interest rates were near 1%. Now here's the macroeconomic principle. When the interest rate falls, borrowing becomes cheaper. Businesses invest more, consumers take loans, and overall spending in the economy increases. This in return stimulates growth. And it worked. The economy recovered, but there was a side effect. Cheap money doesn't just create growth, it creates bubbles. With low interest rates, mortgage payments became cheaper. Suddenly, more people could afford houses. Demand for homes skyrocketed. Prices rose rapidly. And when prices rise fast, psychology changes. People stop buying homes to live in, they start buying homes to flip for profit. Banks, seeing such a high demand, loosened lending standards. They offered adjustable rate mortgages, loans with low introductory rates that would reset higher later. Borrowers believed interest rates are low, they'll stay low. But macroeconomic doesn't work on belief, it works on cycles. Between 2004 and 2006, the Federal Reserve began raising interest rates to control inflation. Rates rose from 1% to over 5%. Now, here's the critical macroeconomic shift. When the interest rates increase, loan repayments increase, adjustable rate mortgages reset higher, borrowers struggle, and defaults increase. Suddenly, millions of homeowners saw their monthly payments jump. Many couldn't afford it. Defaults surged. And when people stopped paying, housing prices stopped rising. Then they fell. Banks weren't just lending money, they were highly leveraged. That means they were borrowing huge amounts to invest in mortgage backed securities. Institutions like Lehman Brothers were operating with extremely thin capital cushions. When housing prices fell, mortgage securities lost value. Because banks were leveraged, even small losses wiped out their capital. And here's another macroeconomic concept, the financial accelerator. When the asset prices fall, banks reduce lending. When lending falls, businesses suffer. And when businesses suffer, unemployment rises. When unemployment rises, defaults increase further. And this begins a vicious cycle. By 2008, no one knew which banks were exposed to toxic assets. Trust disappeared. Banks stopped lending to each other. This became a liquidity crisis. In September 2008, Lehman Brothers collapsed. Markets crashed globally. Credit froze. The economy entered a severe recession. To stop total collapse, the Federal Reserve did something extraordinary. It slashed interest rates back to near zero. But this time, that wasn't enough. So it introduced quantitative easing, which means printing to buy government bonds and inject liquidity into the system. Governments launched stimulus packages. Banks were recapitalized. The goal was simple, restore confidence, restart lending, prevent another Great Depression. The 2008 crisis teaches us three macroeconomic truths. Interest rates shape behavior. Cheap money can inflate dangerous bubbles. Financial leverage amplifies small shocks into global crisis. Interest rates are not just numbers, they are signals. And when those signals are distorted, entire economies can misprice risk. Before I end this video, I just want to mention that this is my second video, and I didn't start this just to gain followers or chase numbers. I started this because the best way to truly understand something is to teach it. Economics, finance, global events, these aren't just headlines, they shape the world we live in. And I want to build a space where we break these concepts down, think critically, and actually understand what's happening around us. So, this channel is as much for you as it is for me. I'm here to learn, and if you're curious about how the world works, come, let's learn together. If that sounds something that you'd like to be a part of, subscribe to the channel, like the video if you found it valuable, and let me know in the comments which topic we should explore further. This is just the beginning. See you in the next one.